All right, good morning, folks. We're just going to very quickly review our MCD trade from yesterday. So the MCD trade, the reason we put it on, we were actually a little bit lower here in the RSI yesterday, right at around 32. We go to our chart here, and of course, we see that MCD finished really close to the high of the day. We probably put this trade on somewhere in this 265 to 207 range, 207.50. And so saw a nice little uptick yesterday. The trade itself, 45 days out from expiration, we sold the 195, 192, 0.5 put spread, and really what we're looking for that is due to the RSI looking like it's a little oversold. We're getting towards oversold, that we're not necessarily going to reverse, but that we aren't going to move lower, okay, lower by the time expiration hits. So really this is the key area for us, 195. This is going to be the area that we need to defend. Okay, so this is going to be the area that we need to defend. We can go ahead and make this a lengthy all the way out to the right little chart. Okay, so let's take a look at our Analyze tab here. Here in MCD, again, we went small just for illustrative purposes, right? So here we are, potential to make $41 per spread, risk $209 per spread. Currently, if we set our slices to the break even, we got a 77.30% chance of profit. Okay, 77.30% chance of profit, 22.7% chance for us to, of course, lose on the trade. Now, we are, of course, going to manage early, okay? And so what we've done is we already have our, as you can see here, we already have our buy order on in order to buy back the spread right before we get to expiration. And so we're looking for right at 50% of the spread. And so we brought in $41 of credit. We've got a buy order back to buy this spread back at 19 cents. Okay, so we're looking to buy this spread back at 19 cents, getting just over 50% of the credit received. Okay, now if we get to 195, and let's just show what that would look like. So if we get to 195, we will roll this trade. Okay, and so the way that a roll works is we would need to go out. Let's just say we wanted to roll to February, get another 20 or so days. We would look here. Let's just go, well, let's say 190, 185. So we would change our strikes to 190, 185, and we would bring in another 43 cents worth of credit. Okay, another 43 cents worth of credit. We might have to take that down to say 40 cents. And we're essentially rolling it further down, right? Further down and getting credit. And then 190 is now our kind of line in the sand that we need to adjust, or we need to do something different, take it off. But really, one of the beauties about put spreads on these, really solid companies, right? So if we go through here, all of these are either solid ETFs or solid companies, right? Where we know for a fact, right, that these are solid blue chip companies, and for us the ability to roll knowing, right, that unless we're in a situation like we were this past February and March, in which we're just seeing a major market crash, right, that these securities are going to hold up for the long term, right? We're not playing penny stocks, we're not playing small caps, we're playing really solid blue chip and selling puts on those, because more often than not, of course, we know that the market goes up and we can buy time, roll down, and continue to move the probabilities in our favor to make these profitable trades. Okay, so this is where we are at. This is the MCD trade from yesterday. We will, of course, continue to monitor. Go ahead and put an alert in for 195 here, and you can do that really easily just by saying create alert 195. Adjust January 22nd MCD put vertical spread. And then one of the things I always like to do with this is to go here and end it at the specified time. That way it automatically comes off my books. Okay, so we're going to create that. If you have any questions, reach out to me at Ryan, R-Y-A-N, @sellthatoption. Otherwise, happy trading.